Welcome to Staffworks Explained. Today we are doing a different type of video where we are doing an investment analysis on Nedbank's group's proposed acquisition of NCBA Group PLC. On January 21st, 2026, Nedbank Group Limited, a major South African bank group, publicly announced that it had submitted a strategic offer to acquire 66% of NCBA Group PLC, one of the Kenya's leading financial services firm, for a total consideration of about 13.9 billion South African rands, which is equivalent to 109.5 billion Kenya shillings or 855 million US dollars. If completed, the transaction will position NCBA as a subsidiary of Nedbank, while allowing the remaining 34% of NCBA shares to continue trading on the Nairobi Security Exchange (NCE). The offer is structured as a 20% cash, 80% newly issued Nedbank ordinary shares on the Johannesburg Stock Exchange (JSE), reflecting a hybrid consideration model which is designed to align long-term shareholder interest and preserve capital discipline. How did this development emerge? Let's look at the timeline and the initial reveal. 21st January 2026, Nedbank issued a formal press release and investment proposal to NCBA Group, signifying its intention to acquire a controlling stake through a partial tender offer. The offer was disclosed in official filings with NCBA and coincided with media reporting and stock market announcement. Prior to this, there were market rumors and early acquisition interest from other Pan-African banks reported in late 2025. For example, media speculation of potential engagement by Standard Bank, Stanbic Holding, surfaced in October 2025. Key disclosure made at the time of announcement include transaction structure: 66% via tender offer with 20% cash and 80% share consideration. Then there is valuation term, where the deal price implies about 1.4 times book value for NCBA. Continued NED listing for the remaining free float of 34% of shares. NCBA operational footprint across East Africa, West Africa, which is Kenya, Uganda, Tanzania, Rwanda, Ghana, and Ivory Coast. And then regulatory approvals are required in Kenya and South Africa, as well as other jurisdictions before completion. NCBA cautionary advice urged investors to exercise care in dealing with NCBA securities, given potential impact and uncertainties during the offer period. How does this affect the market prices and share prices? Within hours of announcement of NCBA's share price reacted sharply, reflecting market reassessment of its valuation compared to the offered price. Early trading significant volume of as shareholders began pricing in terms of the premium implied by Nedbank offer relative to pre-announcement trading, and then volatility due to uncertainty around regulatory approvals and investor acceptance. There has been significant investor caution, with NCBA formally warning that its security could experience material price effects during the tender process. What is the structure and naming of this transaction? The deal structure: this acquisition is best described as strategic partial takeover via tender offer, which is a common structure when an acquiring entity seeks approval or control but does not intend to compulsorily buy out all minority shareholders. It means shareholders are offered the right, not the obligation, to sell their shares. The acquirer gains a controlling stake without triggering mandatory full offer rules initially, and then the seller can retain minority shares or stakes that remain publicly traded. Why this name? It's because a strategic partial takeover accurately conveys strategic intent, which is the expansion of Nedbank. There is partial control, 66%, rather than full 100% ownership, and then there is tender offer mechanism, which is the legal instrument used. This structure benefits both sides by facilitating capital allocation efficiency while enabling ongoing market liquidity for minority shareholders. What is the implication for key stakeholders? Starting with the Nedbank group, we have strategic benefits being regional diversification. The deal greatly expands Nedbank's presence in East Africa, uh, fastest growing market, a region with higher GDP growth compared to Southern Africa, mature market. And then there is new revenue stream for this bank, where NCBA digital banking base and loan portfolio provide higher growth potential in consumer and SME banking. We have risks which include integration challenges across jurisdiction, regulatory clearance risk, and market reaction to share dilution. Then there is capital market effect, where the issuance of new Nedbank shares will dilute existing shareholders, but is expected to create long-term value through strategic positioning. For NCBA Group, we have operational continuity, where NCBA will maintain its brand identity, leadership, as well as governance and NSE listing, preserving continuity for customers and Kenyan stakeholders. There is access to capital, where the backing of a larger institution should improve capital access for growth initiatives, especially cross-border lending and digital finance. Potential regulatory compliance, where NCBA operations across multiple nations must align with various regulatory requirements as part of approval condition. Then we have for NCBA shareholders, the impact is that for minority investors, shareholders retain the choice to sell into tender offer or remain invested in their free float holdings. And then the offer terms include premium 20% cash plus equity, which may be attractive versus holding market risk. In terms of institutional constraints, certain institutional investors who cannot hold offshore equities may prefer the cash portion, affecting the tender dynamics. In terms of liquidity, continued NSE listing ensures ongoing liquidity for non-tendered shares. The impact on Kenya's economy: these are positive signals. Foreign direct investment in Kenya financial sector signals confidence in the economy and financial market. It may attract additional cross-border deals. In terms of financial sector integration, it reinforces Kenya's role as a regional financial hub. Potential risk for economy or for the Kenyan economy is concentration if domestic controls decrease significantly, and then there's regulatory scrutiny, which will increase to protect systemic stability. What are the investors' recommendations pre and post completion? In pre-completion period, which is before the deal is finalized, investors should monitor regulatory approvals. Investors' decisions should await outcomes from Kenya's central bank and CMA, as well as South African regulators. Tender offer evaluations: they should compare the offer price versus intrinsic value and alternative expectation under continued standalone growth. Then in terms of portfolio impact, the investor should ensure exposure aligns with the risk tolerance, especially if NCBA shares are a large holding. Post completion period, the investors should reassess valuation. If the deal completes, reassess NCBA's exposure based on the new corporate structure and performance metrics and the Nedbank ownership. And then they should understand share treatment. Shareholders receiving Nedbank shares should assess implication for dividends, liquidity, and foreign exchange risk, given the cross-vesting. And then in terms of long-term strategy, investors may benefit if the combined entity delivers enhanced profitability and regional growth. In conclusion, you can say that the proposed acquisition of a controlling stake in NCBA Group by Nedbank is one of the most significant cross-border moves in East and Southern African banking sector in the recent years. Structured as a strategic partial takeover through a tender offer, it offers strategic expansion opportunities for Nedbank and potential value realization for NCBA shareholders, while preserving NCBA market presence in Kenya. Regulatory scrutiny and investor confidence will be critical determinants of the deal's success. So thank you for reaching this far. If this is your first time here, please consider subscribing to this channel. We'll be doing more videos from investment point of view. Thank you.